Mr. Stagg here. In the mid-20th century, few would have guessed that a struggling textile mill in New England would one day become one of the most valuable companies in the world. Berkshire Hathaway was on its deathbed, a relic of America's fading manufacturing era. But through the vision of a young investor from Omaha, Warren Buffett, and the wisdom of his lifelong partner Charlie Munger, that dying mill transformed into a trillion-dollar empire. This isn't just the story of a company. It's the story of how discipline, patience, and second chances can rewrite destiny. Along the way, it created fortunes, reshaped American capitalism, and turned Omaha into the unlikely financial capital of the world. This is the Berkshire Hathaway story. Chapter 1. A dying textile mill. Berkshire Hathaway's origins go back to the mid-1800s with two New England textile firms, Berkshire Fine Spinning and Hathaway Manufacturing. They merged in 1955, hoping to survive the slow collapse of the American textile industry. By the 1960s, however, the writing was on the wall. Cheap imports, rising labor costs, and outdated equipment meant the company was struggling. Its stock price reflected this decline, trading below the value of its assets. That is when a young investor from Omaha spotted an opportunity. Chapter 2. The making of Warren Buffett. Warren Edward Buffett was born in 1930 in Omaha, Nebraska. His father, Howard Buffett, was a stockbroker and later a U.S. congressman. Warren showed an interest in money early, memorizing stock tickers, selling Coca-Cola bottles door to door, and running small businesses before he was even a teenager. At age 11, he bought his first stock, learning the pain of selling too early when the price later skyrocketed. After attending the University of Nebraska and Columbia Business School, he studied under Benjamin Graham, the father of value investing. Graham's philosophy of buying undervalued companies would become Buffett's foundation. Before Warren Buffett thought about taking over a textile mill in New England, he was already quietly amassing his fortune in Omaha. After studying under Benjamin Graham at Columbia Business School, Buffett returned to Nebraska with a deep understanding of value investing, the art of buying stocks for less than their intrinsic worth and holding them patiently. In 1956, he started his first investment partnership, Buffett Partnership Limited, pooling capital from family, friends, and a few local investors. His strategy was simple yet disciplined: invest in undervalued companies, reinvest profits, and avoid unnecessary risk. Unlike many young investors, Buffett didn't chase the latest market fad or speculative stock. He looked for businesses with solid fundamentals that others overlooked. Over the next few years, the partnerships grew rapidly. Using compounding and careful selection, Buffett transformed modest sums into substantial wealth. By the early 1960s, he controlled several $1 million, a fortune that gave him both credibility and firepower in the investment world. This capital would become his arsenal, the foundation that allowed him to start buying shares of Berkshire Hathaway quietly, without alerting the company's management or triggering panic in the market. It wasn't just money he accumulated. Buffett was building expertise, discipline, and confidence. Each investment taught him lessons about risk, patience, and the value of waiting for the right opportunity. By the time he turned his attention to Berkshire Hathaway, he wasn't a hopeful gambler. He was a seasoned investor with the knowledge, capital, and strategy to take control of a company and transform it into something far larger than anyone had imagined. Chapter 3. Taking control of Berkshire. In 1962, Buffett began buying Berkshire Hathaway shares for around $7.50 each. He didn't want to run a textile business, but when he felt slighted by management over a stock buyback, his small Omaha-based investment partnerships provided the capital. But it was his disciplined approach to valuation, margin of safety, and long-term thinking that allowed him to buy enough stock to eventually take over. By 1965, Warren Buffett oversaw Berkshire Hathaway. Though he later admitted it was one of his worst business decisions, it became the shell through which he built his empire. The textile business would eventually close in 1985, but by then Berkshire was already becoming something far greater. During this period, Buffett wasn't just buying a company, he was building a platform. The acquisition of Berkshire Hathaway would become the foundation for his future empire, a vessel through which he could acquire insurance companies, railroads, consumer brands, and eventually tech giants. Every dollar he carefully invested in those early years compounded, creating the war chest that would enable him to transform a dying textile mill into a $1 trillion conglomerate. Chapter 4. Enter Charlie Munger. Charlie Munger, born in Omaha in 1924, was Buffett's intellectual equal and closest partner. Briefly attended the University of Michigan before serving as a meteorologist in the U.S. Army Air Corps during World War II. Munger initially practiced law at Wright and Garrett in Los Angeles, but soon realized his true passion was investing, not litigation. He started investing independently in real estate and securities, often using strategies that mirrored his lifelong philosophy: think long-term, focus on intrinsic value, and avoid unnecessary risk. He also ran an investment partnership in the late 1960s, which delivered strong returns for its investors. A Harvard-educated lawyer turned investor, Munger introduced Buffett to a new way of thinking. Instead of buying cigar butts, cheap, dying companies with a few puffs left, why not buy wonderful businesses at fair prices and hold them forever, what Buffett later called moats? This shift in mindset would transform Berkshire. Buffett credits Munger with broadening his horizon and making him a better investor. When Munger joined Buffett formally, as vice chairman of Berkshire Hathaway in 1978, he didn't just bring money, he brought wisdom. His emphasis on high-quality businesses, long-term compounding, and rational decision-making helped guide Buffett's capital allocation decisions, including the company's later acquisitions of companies like See's Candies, GEICO, and eventually Apple. Together, Buffett and Munger combined capital, discipline, and judgment into an unparalleled investing machine. Chapter 5: Building the Empire and the Power of Float. The key turning point came when Berkshire moved into insurance. In 1967, Buffett bought National Indemnity Company and later GEICO. Insurance companies collect premiums up front and pay claims later. The money in between is called float. This float, which today exceeds $160 billion, gave Berkshire a perpetual source of investable capital. Buffett could use float to buy stocks, bonds, or even entire businesses, compounding wealth on an unprecedented scale. From the 1970s onward, Berkshire became known for acquiring strong businesses. See's Candies, bought in 1972 for $25 million, taught Buffett the value of strong brands and customer loyalty. His stake in the Washington Post in 1973 became legendary. In 1988, Buffett bought into Coca-Cola after the crash, eventually owning 400 million shares, a decision that made Berkshire billions. In 2010, Berkshire acquired Burlington Northern Santa Fe Railway for $44 billion, securing a stake in America's industrial backbone. More recently, Apple has become Berkshire's largest holding, worth over $100 billion. Alongside these, Berkshire outright owns Dairy Queen, Duracell, Fruit of the Loom, NetJets, Benjamin Moore, and dozens more. Chapter 6: Weathering the 2008 Financial Storm. By 2008, the world was on fire, not literally, but financially. Banks were collapsing, credit markets froze, and investors everywhere were panicking. The global economy teetered on the brink of disaster. Yet from Omaha, Buffett and Munger calmly assessed the chaos, armed with decades of experience and the capital to act decisively. Unlike many investors who were fleeing the market, Buffett saw opportunity in crisis. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." This philosophy guided Berkshire through turbulence. While others scrambled to sell, Buffett and Munger sought undervalued companies with solid fundamentals, ready to provide long-term capital when it was most scarce. During the financial crisis, Berkshire Hathaway made several bold moves. In 2008, they invested $5 billion in Goldman Sachs, buying preferred stock with generous dividends and warrants to purchase common shares. This deal not only helped stabilize Goldman, but also yielded enormous returns for Berkshire in the years that followed. Similarly, they invested $3 billion in General Electric, again providing much-needed capital while securing favorable terms. Buffett's ability to act during the 2008 crisis wasn't just about money. It was about reputation, trust, and patience. Companies turned to him because they knew Berkshire would honor agreements, provide liquidity, and take a long-term view. Traits in short supply during a panic. Munger's influence was equally vital, helping Buffett evaluate the quality of counterparties and the prudence of each deal. By the time the dust settled, Berkshire Hathaway had emerged stronger than ever. While the broader market had been decimated, Buffett and Munger's capital allocation and disciplined investing had preserved and grown the company's value. The 2008 crisis didn't just test their strategy, it validated it. demonstrating the power of patience, rationality, and the ability to act decisively when fear dominates the market. Chapter 7. The Oracle and the Philosopher. As of 2025, Berkshire Hathaway is worth around $1 trillion, ranking among the largest companies in the world. Its Class A shares trade for more than $600,000 each, making them the most expensive publicly traded shares in history. Berkshire generates over $300 billion in annual revenue and holds more than $350 billion in equity securities. With over 380,000 employees, Berkshire's size rivals national economies. Buffett himself is worth $130 billion, though he still lives in the same Omaha home he bought in 1958 for $31,500. Buffett and Munger became cultural icons. Buffett, known as the Oracle of Omaha, gained a reputation for his annual letters, filled with plain-spoken wisdom. Munger, who passed away in 2023 at the age of 99, was famous for his sharp wit and no-nonsense philosophy. Together, they hosted Berkshire's annual meetings, nicknamed the Woodstock for Capitalists, where tens of thousands of investors would flock to Omaha each year. Buffett's humility and Munger's wisdom made them a duo unlike any in business history. A modest $1,000 investment in Berkshire in 1965 would today be worth roughly $35 million, thanks to Buffett's disciplined acquisition strategy, reinvestment of earnings, and avoidance of short-term thinking. Buffett often highlights this as a lesson in patience and discipline. He once quipped, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." For early investors in Berkshire, this wasn't just philosophy, it was literal wealth creation. Chapter 8. Family and Philanthropy. Buffett has 3 children, Susie, Howard, and Peter, none of whom will inherit control of Berkshire. Instead, Buffett pledged to donate more than 99% of his wealth, mostly through the Gates Foundation. Munger, with 8 children, also gave generously to causes in education and healthcare. This commitment to philanthropy set them apart from many billionaires. Chapter 9. Succession and the Future. Buffett is now in his mid-90s but remains chairman and CEO. His successor is Greg Abel, who runs Berkshire's non-insurance operations. Ajit Jain oversees the insurance side. Both men are deeply respected, and Buffett has expressed complete confidence in them. Still, the market wonders what happens when Buffett is no longer at the helm. Will Berkshire maintain its unique culture of discipline, or will it drift like so many giants once their founders are gone? Chapter 10. Legacy and Lessons. The Berkshire Hathaway story is about patience, discipline, and vision. It shows how even mistakes, like buying a failing textile mill, can lead to unimaginable success if paired with the right philosophy. Buffett and Munger built not just a company, but a culture that values integrity, trust, and long-term thinking. For investors, Berkshire remains a beacon of what's possible with compounding prudence and the courage to think differently. Thanks for watching. If you enjoyed this origin story, be sure to like, comment, and subscribe to Stag Research, your go-to channel for business deep dives and founder legacies. Got a hot take on Berkshire Hathaway's future? Drop it in the comments, Mr. Stag. Logging off.